Welcome to The Explainer. Today, we are really diving into the financial engine of the whole venture capital world. We're going to break down exactly how VCs make their money, and you'll see why their entire business model really shapes the kinds of startups that we hear about every single day. So let's pull back the curtain and see how the money actually flows. All right, to kick things off, let's look at a pretty startling number. Research shows that a full 1/3 of all investments made by venture capitalists end up as a partial or even a total loss for the fund. Just think about that for a second. For every 3 bets they place, 1 is basically a write-off. And that, of course, leads to the big question. How on earth do you build a profitable business when so many of your core investments completely fail? The whole model seems totally backward, right? But the answer? Well, it's pretty fascinating. So, the secret to surviving all those losses, it all lies in how VCs get paid. See, it's not one paycheck, but 2 completely different streams of income, and each one has a very different job. The first income stream is, well, it's all about keeping the lights on. It's the steady, predictable cash flow that lets the firm pay its bills, pay its people, and keep scouting for new companies, no matter how crazy their current investments are performing. This is what's called the management fee. So picture a $100 million fund. The VC firm would typically get about 2% of that, so $2 million every single year. That money covers salaries, office space, travel, all the costs of doing research on potential investments. It's basically the operational bedrock of the firm. But, and this is a big but, that fee isn't where VCs make the real money. That comes from the second, way more lucrative and way more uncertain part of their paycheck. This is what fuels the entire high-risk, high-reward game they're playing. This is called carried interest, or just carry for short. It's the VC's slice of the actual profits from their successful investments. Now here's the crucial part. It's only paid out after the fund's original investors get all of their initial money back. So VCs only get this massive reward if they make their investors' money first. And when you see them side by side like this, the contrast is it's stark. You've got the management fee, let's call it the salary. It's guaranteed every year and it keeps the business running. And then on the other side, you've got carried interest, the grand prize. This is totally uncertain, it hinges completely on successful exits, and it's the performance bonus that can literally create generational wealth. Right, so VCs can't actually collect that grand prize, that carried interest, until their paper gains in a startup get turned into cold, hard cash. This is the moment the entire industry is built around. This whole process is known as an exit, or a liquidity event. It usually happens when a startup gets bought by a bigger company, that's an acquisition, or it goes public through an IPO. Only then is the investment's value actually realized. The cash flows back to the fund, the initial investors get paid back first, and then the profits are split up. And this quote right here, it shows a key piece of protection that's built right into these deals. Deal terms often include something called a liquidation preference. What that basically means is that in almost every exit scenario, especially in acquisition, the venture capitalists are guaranteed to get their investment money back before anyone else, including the founders, sees a single dollar. Okay, so now let's get into the high-stakes math of it all. How do VCs possibly overcome that 1 in 3 failure rate to actually generate the massive profits they need to get paid that carried interest? Here's the key, and maybe the most important thing to understand about venture capital: they are not playing for small, consistent wins. They're not trying to hit a bunch of singles and doubles. Their entire strategy is based on something called the power law, which means they are hunting for a tiny number of outliers that deliver truly massive, fund-changing returns. And that same study gives us this incredible breakdown. So as we said, 1/3 of the investments lose money. The majority in the middle give you a small to moderate return, maybe 1 to 5 times your money back. But then you have this tiny fraction over on the right, around 7%. Those are the massive home runs. And here is the absolute kicker. Those few home runs, that tiny 7% of deals, they account for more than 60% of the total profits of the entire fund. The success of the whole portfolio rests on the shoulders of just a handful of companies. It's insane. So the takeaway here is that the entire venture capital model is built on finding that one company that can return 10 times, 50 times, maybe even 100 times the initial investment. A single massive success, what we call a unicorn. It has to generate enough profit to cover all the losses from the failed companies and still deliver an amazing return to the fund's investors. Now, this financial reality, it's not just some inside baseball detail for investors. It has profound, real-world consequences for the kinds of companies that get funded and the insane pressure their founders are put under. What you really need to take away from this is that the VC's hunt for home runs is what directly creates that grow-at-all-costs mentality we see in the startup world. They need to back companies targeting gigantic markets that have the potential to scale incredibly fast. A solid, profitable business that grows, say, 20% a year, that's a fantastic business, but it just doesn't fit the VC model. It won't deliver that massive return needed to make the whole fund's math work out. And that leaves us with a final and pretty provocative thought. This financial model, which is so heavily skewed towards finding a very specific, very narrow type of hypergrowth company, does it ultimately help or hinder true innovation? Or does it leave countless valuable, sustainable, but maybe less explosive ideas on the sidelines? That really is the billion-dollar question at the very heart of the venture world.